Hi, good morning, everyone. It's Sean with Paycheck to Portfolio. Today, I'm going to talk about how to live off of your portfolio and how that's part of my FIRE strategy, which stands for Financially Independent Retire Early. I'm going to talk about the process and the process map here on a high level, and then look at some of my portfolio images just so I'm not clicking around, but I will show you those transparently as well. And then we're going to look at some poll questions that I put out earlier in the week just so I can interact directly with some of those questions. But before we jump into this, I'm going to do my portfolio update like I do every week just to see how the portfolio is doing. Currently, my net account value is sitting at $153,255. My total unrealized gain is sitting at $38,815. Friday, we were down, but last week was a really good week in the market. Again, rate cuts happened, the market's settling. Obviously, a lot of earnings and just the seasonality that we're going into. It was an overall good week in the market. If you look at my performance below, year to date, I'm sitting basically at 38% cumulative return. The S&P is at 12.5, the Nasdaq's at 15.5, the Dow is at 8.7, and the Russell's at 10.3. Looking at the 1 year, I'm sitting at 48% cumulative return. S&P is basically at 17%. The Nasdaq's getting close to 26%. The Dow is at 10.5%, and the Russell's creeping up to 12%. Looking at the 3 year, I'm sitting at 113%, which is really exciting for me to break that 100% threshold and to keep moving up. The S&P 500 is at 81.5%, basically 82% actually. The Nasdaq's at 109, the Dow's at 58, and the Russell's at 47%. So what this is time-weighted return. This does not include any cash flow coming into the brokerage or any cash flow being spent from the brokerage. This really is just the growth portfolio and dividends received. Looking at my historical values tab, this does account for any cash that comes into the brokerage and any cash that's spent out of the brokerage. You can see 1 year ago, I was sitting at $102,538 net portfolio value. Over the last year, my portfolio value is up to $153,333. So while living out of my brokerage and being fully invested, I'm up $50,795. We're going to talk about my system if you're new to the channel here, and we'll jump right into that piece of it and how I live off of my portfolio. So if you're new to my channel, I made a very high level process map just so it's easy to track and follow. All of my W-2 income rolls into my brokerage account instead of a traditional checking account, such as Wells Fargo, Capital One, and others. All of my income goes directly into the brokerage account. I take that income and I invest in the three buckets. The first bucket would be growth stocks, such as SPYG. That's an S&P 500 growth ETF. It tends to outperform SPY because it's more tech weighted, so it has more NVIDIA holdings than others. I hold McDonald's, Costco, and others. So those are your traditional long-term growth stocks. So that's my first bucket that I invest into. My second bucket would be closed-end funds, such as Cornerstone, CLM, CRF, and Goff. Some of these funds, especially Cornerstone, will drip at the NAV, which stands for net asset value. So they pay an 18% dividend, then they drip that dividend down at their net asset value, which is currently about 21% discount. So you're getting the dividend, the discount, and then you can play what's called the rights offering every year. If you want more information on Cornerstone, please check my playlist and my channel. I have a video specifically talking about the Cornerstone rights offering and how I play that. And then the third bucket is high yield ETFs, such as QQQI, SPYI, and others. These I take as cash payouts, and they cover my margin interest and they erode my expenses. So basically, the next step would be dividends flow in the form of cash flow. So I'm getting compounding, growth, and cash flow. And over time, what that's going to do is it's going to snowball and fully erode my living expenses, which will set me free from a 9-to-5 job. So dividends come in the form of cash flow. My bills are paid via a margin bridge. So what my dividends don't cover In the form of expenses, margin will bridge or float the difference. So if my dividends are $4,000 and my expenses are $8,000, obviously 50% of that is covered by dividends. And then the other $4,000 would be tapped as a form of a margin float, which would tap my portfolio equity. And then that compounding cycle continues. So, most people, they go to a job, they trade their time for money, they spend that money to zero, and then they got to go back and trade that time for money and keep that vicious cycle continuing. And then, we're taught to invest our leftovers, and then maybe 30 years we can retire. In this system, I'm front loading my full paycheck, accumulating assets and wealth, creating cash flow, which will ultimately free me from a 9 to 5 job in a much quicker time than the traditional corporate American process goes. So some of the screenshots I have here, this is my balances tab in E-Trade. So basically what this shows you, and I know it's a lot on one screen, but I'm trying to make it clear for people to understand. So looking right down here, this is my paycheck that just hit yesterday. So $5,100 came into the account. This will release next Wednesday. But when this comes into the account, it pays down my margin balance, which is right here. Cash will always come in and pay down the margin balance first, which in turn increases my margin equity percentage. I simply turn around and reinvest that margin equity percentage and reinvest it and live off of it. Sometimes this trips people up because they think cash in, cash out, because we're so conditioned to think of the normal bank system, one for one. And I'm flipping that in the sense that I am fully investing and I'm living off of the equity within my brokerage, and I'm simply tapping that equity. So it's not just simply moving around money. That money comes in, reduces my margin balance, increases my margin equity. I turn around and fully deploy that equity, which in turn snowballs my dividends and creates assets that I continue to own and that pay me and accumulate over time. So I wanted to show you exactly how that looks on E-Trade. If you want to see that in the brokerage account, all you have to do is click on the balances tab right here, and it takes you to the same screenshot I just took, just for the sake of making it easy. If you look at my holdings, again, this is a snippet of my portfolio. Again, you can see SPYG growth, McDonald's growth, CLM CRF, closed-end funds, Costco growth, QQQI high yield, SPYI high yield, QQQY high yield, and GOF is another closed-end fund. So I own other funds outside of this. I'm just trying to show you from the very top of my portfolio how I'm investing into those three buckets. And I'll jump into more details when we get to the poll questions, is how I'm divvying those up and how I decide what to purchase. And then at the bottom right here is my estimated income tab. On E-Trade, all you have to do is click on, if you go to your portfolios and you click estimated income, it will project out for you here just so you can see how to get to it. But looking at the snippet, my next 1 year projected income is $51,493. So I need about $100,000 of living expenses to cover my core expenses every year with a family of 6. So I'm about 51%, approaching 52% of the way there. Now, what E-Trade does is they take the last dividend payment and they annualize it out over 12 months. So in some videos that you watch in my channel, you might see that this is 48,000. In other videos, you might see it's 54,000. I average right around 50 to 51,000 right now, but each paycheck that accumulates more and more, and that's what's compounding in the form of cash flow. Again, I'm getting growth from the portfolio. I'm getting compounding from the portfolio, and I'm getting cash flow as well. So I'm getting all three of those things working for me in the same direction. And then I put some simple math down here just to show you how this works essentially. So basically, if I take $5,100 and I invest into a blended yield of 20%, just for an estimate, some of these high yield funds pay 14%, some of them pay 50%, some of them pay 30%. They're running a covered call, covered put type of strategy on a lot of the high yield funds that have been around for a long time that individual investors would run. So I just took a conservative 20% for visualization here. And you could see that one paycheck would equate to about $1,000 a year of cash flow. That doesn't include any growth or any compound, just straight cash flow. That same $5,100 that I'm fully deploying, I'm paying an 8.4% margin interest rate on E-Trade, which would cost me $428 a year. So every paycheck in this simple example, I'm creating a business spread on of approximately $600. It's more than that typically, but this is a very simple way to show you how I'm arbitraging my own W-2 income, paycheck after paycheck, month after month, year after year. And that's what will essentially set me free. Companies do this with capital investments all the time. Private equity companies do this with investments, obviously, all the time. You take a loan or you take an investment and you create cash flow that creates a business spread, and that's how your business grows. And I'm treating my basically finances like I would run a private equity business, which I've been blessed and fortunate enough to do in my career, but the concepts are the same. So hopefully that high level and getting down into the nitty gritty with the specific images helps. Looking at the poll questions, I put out a poll every week on YouTube. Typically, I try to ask questions around Wednesday or Thursday during the week. And so the poll questions were broken up into 3 separate items: what to invest in each month, how margin actually works, and then how to pay bills without touching the paycheck. And then I grabbed some common themed questions from specific users in YouTube that I'm going to talk through here real quick. And then I'm going to show you a tool that you can use on Discord to actually look at your own compounding, which is really neat. It's called our Fire Model Pro. And then we'll go on from there. So splitting across the 3 buckets, when my paycheck comes in, I invest in the growth funds, just like I said, SPYG, McDonald's, Costco, Berkshire Hathaway, and others. This provides me steady appreciation, and I drip these dividends. Closed-end funds, such as Cornerstone and Goff, like we talked about, high yield, drip it NAV for acceleration. And then I have my core income funds, and I have a whole bunch of them: QQQI, SPYI, YMAX, MISTI, AMSI. These are high cash dividends to cover my margin and my bills. I have a hard rule of thumb. I always maintain 50% equity at all times, but when my paycheck comes in, I'll split it into 50% growth, closed-end funds, and 50% high yield. I use market evaluation to tell me what to invest in at any given point, right? So if there's a growth stock that's down, that's below its 200-day moving average or looks cheap on its chart, I might go heavier into that specific growth fund. These are general rules, not hard rules. You want to use some common sense when you're applying these business strategies. How margin actually works: margin is a short-term credit line, very much like a home equity line of credit that I'm using to bridge bills when my dividends are short, as I articulated on the previous page. Bills are paid with dividends first, and then margin fills the gap. When you hear me say I'm floating my bills or I'm bridging my expenses, that's what I'm talking about specifically. Again, I always maintain 50% plus equity at all times. That's my safety threshold. That's what I actually own, and you can find that on the balances tab that I talked about previously. Basically, I'm creating a margin arbitrage. I'm borrowing at 8.4%, reinvesting at 20 or 30% plus yields, and I'm creating a business spread paycheck after paycheck, just like, again, a private equity company would do or any business would do. Margin would decline naturally as dividends rise over time. I will show you that in the calculator here because I'm very visual myself, and I know many people are, and it's easier to see on an Excel file. In the end, margin can also be used to buy assets, but you need to have caution to maintain safe equity. So what I see a lot in my community and in the posts is folks will get a margin account. They're trying to float their bills, but they've went ahead and bought additional assets to create growth or income. And then they've soaked up a lot of their equity capabilities, which is limiting their abilities to float their expenses. And so The power is in fully compounding your income, whether that's W-2 income, whether that's business income, or both. So be careful when you're using margin to buy additional assets. You can certainly do that, and you can certainly create more business arbitrage that way, but you want to have enough equity to float your bills. So how to pay your bills without touching your paycheck was one of the questions. Again, you direct your paycheck into the brokerage, you fully invest immediately, whether that's cash you're bringing in for the first time, or that's equity when you're bridging with a margin float or a margin bridge. Dividends from high yields are paid in cash. I do not direct those funds. I take those as cash to cover margin and expenses every month. Bills are paid directly from my brokerage with a debit card that E-Trade sent me. I can swipe it just like any debit card. I can pull cash from it, or I can transfer. My mortgage is auto deducted from my brokerage. It has a routing number and an account number, and it's auto drafted directly from the brokerage account. Some of my members in Discord, they'll spend on credit cards and then they'll pay their credit cards off every month as well to create more of a spread from a cash back perspective. I haven't done that yet. I'm considering doing that. But when I see my net account value go down when I'm spending, I feel like it controls my spending a little bit better. So basically, if dividends don't cover bills, margin bridges the gap like we talked about before. So I'm looking at this snowball effect. As dividends grow and my account equity grows, my margin reliance can disappear. I can choose to reduce my margin balance or simply reinvest that margin to create more of a business spread. So high level, at the end of the day, when you take all the nitty gritty details, it's income and margin arbitrage. So I'm going to show you just a tool, and then I'm going to go through those individual questions. But on our Discord, if you're interested, we have multiple resources. One of those resources is a monthly membership with multiple tools that I'm showing on some of these videos. We have a Fire Model Pro calculator right here. Basically, the way that this works is you can put in your specific holdings. Again, growth, closed-end funds, high yield funds. You can update the yield here, and it will grab the specific yields online, and it will grab the Cornerstone Drip at NAV discount currently. You can put your user inputs in here. In this example, we're starting with a $50,000 portfolio, no margin debt, W-2 contribution at $85,000, 4% inflation rate, $78,000 living expenses, and then the blended yields from the investments, and then 8.4% margin interest rate. What the calculator does is it spits out basically a forward-looking projection. So in month one, you would have $50,000 invested. Your drip dividends would be $298. Your non-drip dividends would be $761. You would have zero interest the first month because you haven't started floating any bills yet. So you would immediately create a positive cash flow of $761. Your monthly living expenses in this example would be $6,500 to start out with. So immediately you're eroding in a good way your expenses down to $5,739. So you would float $5,739, your W-2 contributions would come in, and your net portfolio value would be the difference between the gross and the net after the margin float. So at this point, your equity is sitting at 88.5%. You can see at the end of the rainbow, if you will, 60 months without changing anything, your gross portfolio value would be over $1 million essentially because of the compounding cycle. Your drip dividends would be about $8,000. Your cash flow, your non-drip dividends would be about $17,000. And you can see your net portfolio value, again, would be over $1 million, and your equity would be about 96%. Your freedom date would come at about month 39 here, row 40, month 39, where you see the zero is where the non-drip dividends have now exceeded the monthly living expenses, and then the margin starts to be reduced. Now, the truth is I'll take some of this margin and create more of an arbitrage for myself, but you can quote unquote pay it off if you would like to create the full equity spread if that's your desire at the end of the day. So basically, this engine compounds in three ways: drip dividends, non-drip dividends. But the most powerful compounding tool is your own income but would have otherwise been spent to zero is now fully invested and fully compounded. So that's the way the system works. And then we have a dashboard that shows you the growth of your portfolio, the equity, the debt and equity trends. You can see the crossover lines we just talked about, the income and expenses, and then basically the cash flow waterfall there. So again, that's available on our Discord, and all of my resources are under every pinned comment in every video right here. What was the impact or stress level when I started living out of my account? It really wasn't a big stress for me. It was just the transition of learning how to manage my margin equity, to maintain my portfolio insurance, and to make sure that I understood the inflows and the outflows of the cash flywheel. So what I recommend for new members or new folks following me is try it with a small bill. You have to pay these bills anyway. If you have a car payment that's $500, bring the $500 into your brokerage account, fully invest that, and then pay your car payment from your margin equity float or your margin equity bridge. And then you can see in a small scale how the cash flow cycle works. So the biggest stressor for me was just learning how to adapt from money in, money out to growing a portfolio and the equity. But again, I had some of that experience managing private equity in my business experience. Another person asks, would be interested to learn how you negotiated your margin interest rate down from 8%. I simply just sent E-Trade. They have a chat feature, and I told them what I was trying to do and asked them to reduce my interest rate, and they did that twice. I've asked a few more times. They've told me no a few more times, but now recently they've told me to call them and to talk to them over the phone. So you simply just have to make the effort to reach out, tell them you're trying to live out of your brokerage, and most will negotiate down with you, especially with the rate cuts going on in the market. For what you're able to share for newbies, might be good to cover pluses and minuses of some of the common brokerages. That was another question over here as well, as far as why E-Trade versus Schwab versus Fidelity. The truth is this system works in multiple brokerages. You can see in our membership Discord, we actually have multiple brokerage channels here, and folks using Robinhood, Schwab, Fidelity, E-Trade. So one isn't necessarily better than the other, but they all kind of have their pros and cons. But all of those systems and platforms work. I even have a gentleman in another country using Interactive Brokers. So all of them work, and all of them are adaptable to the system. So I prefer E-Trade just because I've been on it for so long and I've mastered the system essentially. So last question here before we wrap up. How does the system affect taxes? Is an LLC better once you've been doing the system for a while? I get the tax question quite a bit. I made a specific video on my channel about the tax effect and, the tax brackets and return of capital. I have an LLC because I have multiple businesses that I've started over the years. Now, my investment account is in a taxable brokerage account, but all of the revenue from all of my business income goes through the LLC as a pass-through entity, which allows me to write off expenses. But honestly, when you see your 1099 come at the end of the year, these companies will separate between ordinary dividends and return of capital. And it's not going to be a huge impact to your taxes. It will impact your taxes like any earned income will, but it's not as big of a factor as I think some people think it is. And, I would leave you with this is when I get a pay raise at work, the first think about the additional income I'm getting, right? And then I deal with the taxes kind of on the back end, whether that means I'm investing more into a 401k, which I do because I have a company match and I work at a government hospital, essentially. So there's some pensions and some other things there, but it's not the first thing I think about when I'm getting a raise. I think, gosh, I'm thankful I'm getting an extra $300 or $400 a month or whatever the case may be, right? So in this case of dividends and in investing, I'm generating cash and my money's working for me as opposed to working against me and being spent to zero. I look at taxes as just a cost of doing business. and creating a positive cash flow spread that will ultimately set me free from a 9 to 5 job. So guys, I love this. And thank you so much for reaching out. I'm so appreciative of the community. I'm humbled and really appreciate everyone. Please keep sending me emails. Please reach out to me if you have any questions. Hope you have a great day, and we'll talk to everybody soon. Bye.